Well, thank you, Sarah. First of all, I'm delighted to be on here today to discuss Anaplan, which is, in our minds, one of the most unique enterprise software companies that we cover. And so we have approached this company in this market well before any activist disclosure, because this company really, from our standpoint, checks all the boxes. It's got very high revenue quality, very great customer base. It's in a large and dynamic market. It's growing really fast. And as you said, one of the nice things, or one of the things that is a trend in our market, is over the last 5 or 6 months, particularly for really high quality public software companies that have nice revenue growth but very little profit, we've seen those companies have their valuations decrease pretty significantly. And for us, that's a big opportunity, because at Thoma Bravo, we have a very unique operating approach where we work in collaboration with management to turn to turn revenue multiples into cash flow multiples over our investment horizon. So when all those things came together, we approached the company, but it was, again, well before any activist disclosure.
But it sounds like you may have more up your sleeve, given where valuations are in tech right now, and software in particular.
We think this is a great time. I mean, these are some of the best companies, like I said, that cover their high growth, they have very high revenue quality. And you're right, we are very busy at the moment.
What about the general market environment? And clearly, it's a ripe time for LBOs. We're seeing potential Nielsen deal in the works. There was the Citrix deal. What about the junk bond market and just how generous financing conditions are right now? Because they've certainly tightened as the Fed has started raising rates.
They have. Now, what we're doing a lot of in our world is we're buying these really high growth, market leading companies at scale. And we are, I think, probably the market leader in doing that. And those companies that are very high growth, we have a really nice set of private capital sources that we can leverage as well, who recognize that the company's recurring revenue that we're borrowing against is a really attractive asset. And so we're in this deal, as an example, that's kind of what we did. Now it's primarily equity, but we're making our returns on growth on the top line and growth and profitability, not necessarily on financial engineering. So we think that will continue as well.
What is the goal here? Are you trying to go up against with this company and some of the others that you're building in your portfolio and SAP? That's the competitor we hear about most when it comes to Anaplan. A Salesforce, perhaps, an Oracle. They all compete, and they're all bigger.
You're right. It's situation specific. We've been doing this for about 20 years, buying these companies, running them independently, competing against large guys. There's always been a place for best of breed software. That's still true today. The fundamentals of these companies are amazing. And in many cases, and it's true in this case as well, we're buying the market leader. Some of those names you mentioned are in the market, but Anaplan is gaining market share. They have been for a very long time. It's cloud native. A lot of the companies you mentioned started with an on-premise solution. And so Anaplan, like many of our companies, are taking market share.
What about the notion in the public market that a lot of these companies had a lot of demand pull forward during the COVID pandemic? That you saw that with the stock price. Anaplan got as high as in the 80s, and that it's going to be tough comparisons and a lot of give back in the coming years, especially as we get back to normal and see a changing consumer environment.
Yeah. They saw some of that, of course, in a way, that pullback, and then there was kind of a reversion, and that's really what created this opportunity, to be honest. And so we think we're on the other side of that. I mean, the growth in their last quarter in new bookings year over year was 60%, which for a company that's over $600 million in revenue is very unusual. So we think that's created a great opportunity for us.